Hi, this is Jared Rogers from Beyond Accountancy. Today's video is about making super contributions before 30 June 2020. It's the two-part video, the first part covering higher income brackets and the second part will cover lower income brackets. As accountants, we can provide tax advice on the implications of advice on different super contribution types and their limits, but a lot of other things to do with super are going to need a financial planner, so we'll be sticking to the things that accountants can advise on. So why super? Well, super is basically a compromise between now and later. If you want more money in your pocket now, you'll have less money later, as in retirement, and you'll have a worse tax outcome. But if you're happy to have less money in your pocket now, the tax system will reward you with less tax and a bigger payout in retirement. So when is later, or when can I access my super? Basically, retirement is the main reason for accessing super. You've got to be at least age 60, unless you're born before 1964, where special rules apply. You can trigger the retirement condition by ceasing a job after the age of 60, leaving the workforce altogether, or by turning 65, whether you're still working or not. The other ways to access super are buying your first home. Now you can do that if you've topped up your super since 1 July 2017. Those voluntary contributions can be withdrawn for your first home. We have a separate video just on that scheme, which I'll link to. There are other reasons as well, like for example, paying large medical expenses or terminal illness, even things like IVF, you can get at your super for that. Basically, it's going to be retirement or a first home. The closer you are to accessing super, the more appealing the tax rates will be for you. So if you're 63, working full time, and you know you're getting your super out in 2 years, it's much more incentive for you to top it up than someone who's 21 with 40 years to go to retirement. Also, if you thought you're going to buy your first home in 2 years' time, then topping up super, the sort of now versus later compromise will be much more in favour of topping up super, because later isn't that far away. Now, not all superannuation contributions will give you a tax break. Only concessional contributions will. There are strategies where non-concessional contributions can help your tax position long term, but we'll be focusing on the kind of contributions that can give you your tax break, which is concessional, subject to the $25,000 limit. So how much tax will you save? Well, it depends on what tax bracket you're in. You'll see in the first two brackets, you save nothing. In fact, in the first bracket, you're worse off making concessional contributions. So the key to tax planning is tax brackets, and the key to effective super contributions is that last column, the difference between your personal tax rate and your superannuation tax rate. This video will focus on the brackets where there's a tax benefit of making concessional contributions. So that's the third bracket and above. If you or your partner is in a low income bracket, please check out part 2 of this video, which will be coming out in the next few days. If you're a non-resident, say you're a landlord with an Australian property but living overseas, you can also use super to offset the tax on your rent. This will apply to your situation as well. So to put it another way, so what's the value or what tax will you save? This is the difference between $1,000 of pre-tax income in your own name or in super. So you'll see that the amount you get to keep is a lot more in super. The sweet spot being between $180,000 and $250,000. That $250,000 limit includes super. So if you had a salary of $230,000 plus super, that would be $250,000 for this purpose. So we're very late in the financial year. If you want to save tax using super, the way to do this will be as a lump sum, as like a top-up or catch-up contribution, and you'll need to act soon. So here are the steps. Work out the maximum amount you can contribute. Decide how much you want to contribute. B, pay the money in by the cut-off date. inform the super fund you're claiming a deduction, and then include the deduction in your tax return. So those are the 5 steps. Let's do a worked example for the first 2. So maximum contribution amounts. Let's say I've got a taxpayer making $120,000 on a 39% tax bracket, and this person hasn't made any voluntary contributions so far this year. So of their $25,000 cap, their employer contribution counts towards that cap, so 9.5% of their salary. So the amount they've got left to top up is $13,600, or at least that's the amount available under the old rules. Under the new carry forward rules, if you didn't use up your limit last year, you can actually carry that forward to this year, as long as your super balance is less than $500,000. So if you go onto MyGov, you can see a summary for your tax file number of how much super is available to you. So this particular example, the taxpayer had $13,965 left. So an unused concessional contributions cap from last year. This means that they, instead of having $28,000, they add the unused amount, so they've got $38,000. They actually have $20,000 available for top up. So step 2, choosing the amount to top up. Well, this person, depending on their circumstances and what they felt was best for them, they could top up anywhere between nothing and $27,565. So you can go higher than $25,000, but you need to make sure those rules do apply to you. So you are under the $500,000 limit. You didn't use your whole cap last year. That's definitely worth double checking. The third step is to pay the money in by the cutoff date. And this seems obvious, but the main point here is that you need to get the money into the fund by the cutoff date that your fund sets. So if you pay the money in on 30 June, there's pretty much no chance they'll count that in this financial year. By the time they process it, it'll be July. So 22nd or 23rd of June is about the time most funds will cut off. Payments are usually done by BPay, and you can call your super fund or use your member login to get the BPay code. It can sometimes be confusing with multiple codes and different contribution types. All those names down the bottom mean the same thing. Any one of those will be fine. So the next step is to inform the super fund you're claiming a tax deduction. There's a form called a Notice of Intent to Claim a Tax Deduction form. Your fund might have its own form specifically, or you can get the form from the ATO website. Basically, you just need to fill out your personal details, enter how much you put into super, and then put how much you're going to claim. So say our person in the case study chose to put in $20,000, they'd say total contributions for the year, $20,000. Contributions claimed as a tax deduction, $20,000. Would make sense in that higher tax bracket to claim the whole lot. Again, with the form, there are timing issues. You don't have to have done it before 30 June, but you need to have done it before you do your tax return. There are also 3 other situations that could cause you to miss out. So if you roll your money over, if you withdraw your money before you've done the form, if you're late on tax and the next financial year ends, then you can't do the form, even though you haven't lodged your tax return. So basically, I recommend do that form when you put the money in. It's much simpler. Check with your fund whether they want you to use their version of the form or just the generic ATO template from ato.gov.au. And the final step is to claim the deduction in your tax return. Just need to make sure you fill out section D12 of the return. Once you've done the notice of intent, though, your super fund should report that to the ATO, and actually that section should pre-fill for you. Now, as I said, I was mostly focusing on lump sums, but another much simpler way to top up your super for the 2021 year is to think about in July how much you want to get in over the course of the year instead of a salary sacrifice. So similar steps, you work out the amount you can contribute, So what's the cap? What's the maximum that you're not going to exceed it? Decide how much you want to contribute per payday. So it might be, say, $500 pre-tax per pay. And you arrange it with your employer. There's no notice of intent. There's no extra paperwork. So in many ways, salary sacrifice is simpler than the lump sum option. If you need assistance with this, we're here to help. We can help work out what your cap is. We can access the ATO information that I showed before in that screenshot and help you to get the money into super, claim the tax deduction correctly, and work out the tax that you'll save on that. Again, we can't advise how much you should put in. That's financial planning, or which fund you should choose, but we can help work out what's going to be tax effective for you. And if you're interested in finding that out, you're welcome to book a tax advice appointment on our website at www.beyondaccountancy.com.au. We also do tax return preparation as well as mortgage advice and refinancing. For now, thanks for watching, and we'll talk to you soon.